Welcome to the show, everyone. We are now live on the Coin Watch Show. This is a weekly show where the CEO of Edge Wallet, Puey, and myself dive into a different coin every week. And this week, we're looking more into the DeFi world. So it's a pretty fascinating world that I'm excited to get further into. But welcome to the show, Paul.
Oh, thanks for having me back. Looking forward to another DeFi project, which actually kind of ties together a few different projects we talked about in the past. But yeah, today we're talking about Curve.
We are talking about Curve Finance. So that's maybe something that I'll intro just before we dive into the specs of Curve and I hand it over. There's this idea of money Lego in the DeFi space. This idea that, you know, when you're playing with Lego blocks and you use all these little nondescript blocks, you put them together and you make a castle, and then you can take those exact same elements and rearrange them and make something completely different, like a car or something completely outside of this world, a spaceship. And so they've coined this phrase money Lego to refer to what's happening in the DeFi space, because you have all of these different protocols who do kinds of yield farming, I guess. They are lending platforms, or they give incentives, or they're dexes, or they're all of the above. And if you put them together in different ways, you get completely different results. So it's like this wonderful, fascinating world of DeFi. And Curve is one of these kind of foundational pieces of this DeFi space. It's a very popular platform that is used in all kinds of other different platforms. There are, you know, relationships with Compound, there are relationships with synthetics, there are all kinds of different relationships. We've talked about those platforms already. We've talked about a lot of DeFi space. So now we're going to look at another one of these kind of underpinnings of this DeFi movement, Curve Finance. And just a heads up as well, I did an interview with Michael Igorov last week, who's the founder of Curve. So if anyone wants to check that out, head over to naomibrockwell.com/memberships, and you can get the video version of that. That's for members only. And then the podcast will also be released soon, so you can dive into that. But do you want to just start us off, Paul? Give us an overview of what Curve is so people can wrap their heads around this.
Got it. So at a high level, Curve is a decentralized exchange. Similar to Uniswap, it's a decentralized exchange without an order book. So for people that have traded on centralized exchanges such as a Bitstamp, a Kraken, a Coinbase Pro, not Coinbase, but Coinbase Pro, you'll notice that the experience is order book focused, in the sense that you will place an order at a certain price, and really you're only able to get that order executed when somebody else takes that order. Meaning you say, I want to sell Bitcoin at $15,000. Well, then someone has to come in and say, okay, that's the price that I want to buy it at, and vice versa. Now, decentralized exchanges such as Uniswap actually utilize a different mechanism, because an order book mechanism is actually just simply too slow and too expensive to implement into a smart contract. So instead, a concept called an automatic market maker is what's being utilized really, really frequently inside of the DeFi space. And I like to think of an automatic market maker as almost like a vending machine. It's simply a vending machine that has a bunch of assets, a bunch of goods. And as one asset starts getting low in supply, it starts increasing the supply of that asset and decreasing the supply of an asset that it has a lot of. So you can kind of think of just, you know, a very simple case, almost like, say, a Bitcoin ATM. Bitcoin ATM that goes two ways has two assets, dollars and Bitcoin. And as that machine gets lower in Bitcoin, it could simply change the price and incentivize people to put Bitcoin in it, and then start to level the supply of these different assets. And so that's effectively what Curve is. It just happens to have a very specific focus, in the sense that its focus is in trading assets that have like value. So definitely stable coins that are pegged to $1 will be in a pool in this vending machine, right? Where the trades between the different assets are more or less, you know, the same value, you know, within about that 5% range. Unlike Uniswap, where you're trading assets that could be very volatile against each other. And there's subtle differences and benefits and changes to the algorithm that Curve has made to really, really fit the model of like kind assets, such that the slippage and the change in price isn't so drastic, which benefits definitely the trader that's looking to trade an asset, as well as the liquidity providers that are providing assets into the system, or basically providing funds or inventory into this vending machine.
And it might be worthwhile just reiterating what you mean by like assets, or assets that won't vary in volatility with each other. So you have all kinds of stable coins. There are like dozens of stable coins, maybe even hundreds. I don't know. There are lots and lots of different projects that are stable coins on Ethereum. So you've got Tether, you've got gosh, I'm
USD,
DAI,
TUSD,
yes, TUSD. Like there are
USDC.
lots of them. So the idea is that the idea of a stable coin, they're all going to be around $1 US. So you put them all together, they're basically going to average out, be around the same price. The same as if you have different versions of like wrapped Bitcoin, for example. So you might have wrapped Bitcoin. There are a bunch of different coins that are pegged to the price of Bitcoin. So you put them all in a pool together. And so what Curve does that differentiates itself from other DEXs, as you already pointed out, is it has this very specific algorithm that figures out the price of these things that is specifically tailored to these like assets. They don't have to worry about wide variability in prices because Ethereum isn't being traded against Bitcoin, for example, which can completely swing in value. And so they can really tailor the platform, which creates this very efficient system.
Exactly. So that tailoring really has to do with making sure that as the supply changes, the price doesn't change as much. So the way this automatic market maker works, like I said, with this vending machine analogy, is such that if I've got two different assets, as the supply of one decreases, I start increasing the price. I mean, if you want to buy this asset that I'm low in supply, I start increasing the price. And with exchanges such as Uniswap, that price starts to increase pretty quickly as my supply decreases. So it's just kind of supply and demand. It's free market, right? It's very libertarian focused, right? Low supply, the price should increase. But for like-kind assets, we don't want the price to change drastically as the supply decreases. So what Curve is doing is they change this formula, this algorithm, where the supply can change quite a bit, but the price still stays relatively stable. However, there's a trade-off there. Is it almost goes through a cliff. As the supply changes between two assets, say you're going between USDT and USDC, and for some reason people are wanting to sell their USDC and buy USDT, and your USDT starts going down and going down, the price still stays fairly stable, but at a certain point, it hits a cliff, and then the price really skyrockets for USDT and then really plummets for USDC. And so the goal is to stay within this range that keeps things stable. And for the most part, with enough liquidity, you're able to stay within that range. And this presents just a general better experience on what we call the, kind of the common use case of this platform, where people are trading back and forth, are expecting a relatively stable price and providing enough liquidity into the system. And in their mind, for the same amount of liquidity as you would put into a product like Uniswap, you're able to provide significantly more stability in price between the assets. And that's really its main differentiator from the viewpoint of the ecosystem, the algorithm, the platform of Curve versus a general automatic market making decentralized exchange such as Uniswap.
And we had a question in the chat there. Is this comparable to a decentralized shapeshift? So just a reminder, if you guys wanted to ask questions, feel free to head over to cointree.app/Naomi Brockwell. You can add all of your questions in there, and then I will see them and I'll answer them on the show. But to answer this one, that's the kind of idea, the idea that this is a decentralized exchange, except there are added perks. So not only can you swap things, swap coins to each other, if they're like assets on here, you can also earn fees if you provide money to the platform, provide liquidity. You can also get added incentives. So we'll dive into all of those little differentiators. And just to kind of drill in on what Paul was saying about these automatic market makers, in case people are having trouble wrapping their heads around these, it does take a while to figure out, but it's kind of like, as he said, there's no one on the other side of your bet with these things. You're not making a direct bet with someone or a direct exchange or trade or anything. These people are adding their funds to a pool, creating what's called a liquidity pool, and it's kind of pre-funded in a way. And so people will come in and they can automatically just like trade instantaneously, which makes it a really efficient process. And so that's a really cool system that I think DeFi has, this idea of this automated market maker. And so, Paul, do you want to dive into like fees and incentives and these partnerships that they have?
Right, exactly. So I like that analogy or that question that someone asked about, hey, is this like a decentralized shapeshift? In many ways, it is. And so imagine, put yourself in the shoes of Shapeshift, and how do you provide that centralized equivalent? Well, Shapeshift is the liquidity provider. They're actually holding a bunch of tokens of all of the tokens that they offer for buying and selling on their platform. So they hold those tokens, they kind of take a bit of a risk on the price of those tokens. But when you sell a token to them, you're adding to their pool of one token, but then they're giving you another token. Now, in the case of Curve, number one, it's only Ethereum and Ethereum-based tokens, specifically ones that are like kind. So that's one limitation relative to a Shapeshift type service, where Shapeshift can go cross-chain. But another is that it's anybody that can provide the liquidity. It's not just the company Shapeshift. In the case of Shapeshift, they're the one with their own money providing liquidity. Here, anybody can come in and say, okay, I'm going to supply some USDT, I'm going to supply some USDC, and vice versa, and vice versa. And similar to Shapeshift, Shapeshift makes a little bit of money. They get a little cut in fees every time someone makes a trade. Well, since they are the liquidity provider, in Curve, by being a liquidity provider, you make those fees instead of Shapeshift. So it really is a very good analogy. Yes, this is the centralized version, a Shapeshift type service, and then the decentralized version with Curve and things like Uniswap. So it definitely does have that analogy. The fees, we're hearing well below 1% is typically what's charged on an exchange, typically around that 0.3%. And that's what goes to the people that hold funds inside of Curve.
Yeah. And I think that it's interesting to talk about the different incentives, because it's not just fees that they offer. Obviously, if you're providing liquidity, you get a portion of the fees when people are using the platform to trade. But there's also interest. So some of the pools offer interest from lending. So there are certain pools, like, for example, certain pools where they take that liquidity and then they put it in like Compound, for example, which is a lending platform. So when Compound lends that money out, you then get fees for that. So kind of interest for you locking up your money. So depending on which pool you put your money in, you could choose like lower risk pools, or you could choose higher risk pools where your money then gets sent out to yet another platform and you earn interest and things from that. And then they also have incentives. So they have these like interesting kind of sponsorship partnership deals with like the synthetics, for example, where people can earn synth tokens, SNX tokens for certain things. So it's like there are just lots of different ways that people can make money on this platform. It's kind of interesting.
And it's interesting you mentioned that how funds that are put into the platform can actually get used on other platforms. Well, the inverse is true as well. Funds that are put on other platforms end up using those funds inside of Curve to gain more fees or more interest on their account. Since Curve does offer these additional fees, we talked previously about the Yearn protocol, where in the Yearn protocol, that exactly can happen as well, where you're earning interest on your money that's being lent out to somebody else through Yearn, but then the funds that are being currently locked are getting put into a product such as Curve. So this is where kind of the Lego building blocks not just build on top of each other, but can actually build in the inverse direction as well. And so yes, you mentioned things like Compound, synthetics, and Yearn as well is another one that ties between Curve and another product.
Yeah, I love that they go both ways, that you rearrange things, you can get a completely different outcome from these things. Like, it's just a very cool, interesting system. And the way that they kind of plug in is, you know, these platforms will just make a call on someone else's smart contract, and they'll just kind of, you know, send it to that smart contract. It's like this world, because it's all built on Ethereum. And someone did ask a clarifying question about that. Don't forget, use the Cointree page for questions if you have any. That's greatly appreciated. But yes, it is built on Ethereum. And that's what makes this world so interesting, because it has the same base layer. You can have all these smart contracts built on top that are all interoperable. And that's kind of the ethos of this DeFi world. It's this interoperability that they have. So it's very, very interesting what can be built. It's kind of exponentially growing because everyone knows that they can plug into all of these different resources, and people are constantly iterating on that.
Yep, and they continually will be, more assets will be added to it. I think that's where we start to get into the entire concept of, well, what is the CRV token itself? You know, there's certain pools that are available on the platform, certain assets that can be added. Well, Can more assets be added? Can interest rates change? Can the fees change? That all starts to come into play when we talk about the actual Curve token, which is the governance token that can really change and modify the entire protocol from the ground up.
So that might be a good segue to go into CRV, because that's essentially what we want to be looking at in this, because it's the governance token of this platform. Although there are so many elements to Curve, you kind of want to cover everything. So CRV is very new. They actually implemented this governance token, I think, was it August that this got started? So and they're still actually in the works, is they have yet to distribute fees. It's accumulating and it hasn't yet been implemented yet. So we'll talk about that in a second, but let's dive into CRV and talk about how all of that works.
So at the high level, CRV is another ERC20 token on Ethereum, can be transacted, sent, received, traded on decentralized exchanges and centralized exchanges, much like other ERC20 tokens. And the goal, much like other DeFi projects, is to provide a governance token. And so while it's a governance token, it does have some additional benefits. As far as the general tokenomics, the token is slated to have a 3 billion maximum token supply. Initially, when it first came out, like you'd mentioned in August, it had an initial supply of about 1.36 billion. Of that, a lot of it went to the Curve shareholders. About 31% of the total, I think it was 31%. 31% of the total went to the shareholders, about 5% to people that already had participated in Curve, meaning they had actually locked value in Curve, and then a small amount, 3% to employees, and a large portion, which is reserved right now, which has not been doled out, which is why there's a difference between that 1.36 billion that initially went out and the 3 billion maximum, is the 61%, which aims to go out to the liquidity providers. This is the liquidity mining term that you hear a lot about in DeFi, and also one that created this gigantic ramp up in August from the different DeFi projects, basically kind of airdropping all of their governance tokens onto people that provided liquidity, making it much more lucrative to provide liquidity in the first place, but at the same time, kind of creating a little bit more of a bubble than we would have liked to see in a project. So that 61% of the total 3 billion maximum is what's basically going to be doled out to people as they provide liquidity over time, much like mining, except that you're mining with liquidity.
I did have a question about that for Michael, because I was thinking, there's always that question everyone asks in different platforms: what happens when these run out? Like when you have a fixed supply and this is being used as an incentive, what happens? And I mean, he made a great point. Like this, the schedule for this being put into circulation is so gradual that it's several hundred years before this happens. It's the same with Bitcoin, right? People say, well, what happens to Bitcoin when the last Bitcoin gets mined? Like, how will miners be incentivized? And it's a great question, but it really, I mean, it's 100 years in the future, several hundred in the case of Curves. So I think it's something like that. I don't think it's something you have to worry about, but I would love your thoughts, Paul.
Yeah, so actually my thoughts are the governance token and mining of the governance token solve a different problem than mining Bitcoin. Mining Bitcoin solves a security problem, right? You need miners incentivized, so to put in all of that work that they're putting into to provide the security, the proof of work. Really, liquidity mining solves a bootstrapping problem. The bootstrapping problem is, let's get enough liquidity into the system so that the product is usable. So if you remember that analogy I made with the vending machine, where you have a certain ratio of amount supply of the different assets. If you have a very small amount of an assets, then buying one asset quickly changes the price, right? Your supply drastically changes. If you've only got 2 Bitcoin in the system, or we're talking Curve and Stablecoins, so you only have $10 worth of USDT of Tether, and matching starting $10 worth of USDC, and someone buys $5, suddenly your ratios shift drastically, and therefore the formula that calculates the next price would shift drastically as well. But if you've got $1 billion, of which the total locked value in Curve is almost $1 billion, it's at $800 million. When someone buys $5, the ratios don't shift much. So liquidity is key in keeping prices stable. And so this is what liquidity mining and these airdrops of the governance tokens are doing. They're just bootstrapping the system, getting a lot of liquidity into the system, making the product usable. Now, once the product is usable, people will actually want to transact on the product, and then the fees are what really make it up. In a way similar to what we say about Bitcoin, in the sense that, well, the miners will now be compensated with fees going forward to secure the system. Whether or not they will be enough to secure the system is another question. But the goal here is that the fees should be enough for the liquidity providers to want to provide liquidity in the system, as you know, in contrast with receiving of the governance tokens. So I don't think it's going to be a problem long term. Like you said, it's 100 years, but even in addition to that, it's a different problem that they're solving. It's not a security problem, it's a liquidity problem.
That's a really good point. So we've talked about the interoperability with different platforms out there. And then there are also these bonuses, which I also had a hard time wrapping my head around, because I was like, what are the bonuses? I think it's actually not a good way to define it, actually, because when they say bonuses, they actually mean that when you put money in, depending on whether the coin goes up or down, you may end up getting back more stable coins than you put in relative to the prices of the other ones. So do you want to kind of dive into that and kind of clarify that point? Because it's not like an extra thing you get. It's just arbitrage basically between coins.
It's basically arbitrage. Right? So, and there's also the potential for loss. So realize that as a market maker, there is an actual career, a job or a company title called a market maker, even in centralized exchanges. And they're given someone else's money, and they basically buy and sell, put market making orders. They're the ones that put an order into the order book of a centralized exchange that says, I will go ahead and sell at this price and I'll buy at this price. And what they're doing is they're providing the liquidity so that the price stays stable. But since they're typically more frequently buying at a lower price and selling at a higher price by providing that liquidity, they make money on that. And in the same sense, there's an opportunity to do the same thing through an automatic market maker. You're depositing your money into the market maker, and it's buying and selling. And what you're hoping at is that it's typically selling at a higher price and buying at a lower price. But that's not necessarily true. And so there's this term called impermanent loss, where as the price starts to change, especially if it's volatile, the automatic market maker is just simply a formula, right? It's not one that tries to say, is the market going to go up? Do I think the market's going to go down? No, it's a simple, straightforward formula, purely based on the supply of the different assets. And it's kind of outside of the scope to give an example of this during the podcast, but there are examples such that as people go and buy assets and sell assets into the system, you might actually be, or the system, the smart contract might be selling at a lower price and effectively buying at a higher price net over time. And this can actually reduce your total yield over the course of a year, where you're hoping that the fees you collect will exceed the loss, but in some cases it won't. And this has happened definitely through various services, especially on Uniswap, where the assets are very volatile. Less so on Curve, where they're relatively stable, and your fees are far more than the difference in price. But in the same sense that you could lose money, you also might make money on this arbitrage opportunity, because the price that people might be buying at might be such that the automatic market maker is selling at a higher price on average than how often it buys back from people. So this is, let's say, examples of this would be difficult without a little graph paper and pictures and whatnot.
We really need that. We need a whiteboard. We need a
whiteboard.
pen.
I know, exactly. Yeah, so we can kind of give examples, but just realize that since it's assets on a system, people are buying from you at certain prices based on a formula. They're selling back to you as in the pool contributor. They're selling assets back to you at another price. There's always a chance that due to the price differential, you're basically bleeding some of the value over time.
I want to just mention, so Andre Amorim, I'm not sure whether that's actually a French name or how to pronounce it, so I'm really sorry if I got that wrong, but he just sent a super chat that said GNU-PG. It seems like it's an advertisement for open encryption standards, which is great, but I really appreciate your support, and thank you so much. And if anyone else has any questions or any comments that they want read on the show, either crypto on Cointree or in super chat is awesome. But thank you, Andre. So it is worthwhile mentioning the gas fees with this, Paul. So when we're talking about trading and arbitrage and all of this, you might think that, well, that's the end of it, right? You can make a little bit on the difference, and so you've made money. But right now on Ethereum, it's so expensive to make
It is.
transactions. And I mean, they're making headway on that. Some people are really skeptical that scaling is ever going to come to Ethereum. But this week was exciting news. I mean, they launched the contract that is basically going to be the bridge between the proof of stake blockchain and the proof of work blockchain. So it's like it's making
It's
headway,
coming. Yeah,
but it's not there yet. And things are really expensive on Ethereum right now. So gas fees are an issue. Congestion on the network is an issue when you're using these platforms, and it's important to be mindful of that.
It is. Fortunately, as someone that's providing the liquidity, the gas fees are typically imparted by the person that's making the trade. So if fees are paid by anyone that's creating a transaction, when liquidity just sits there in a pool, there's no fees that are actually getting imparted. It's just sitting there. Now, as soon as someone wants to make a trade, you're executing some functionality on the smart contract. That functionality is calculating what the price will be that you'll be able to buy an asset, and then it will send out that asset back to you. You'll receive an asset, execute a smart contract, and then send an asset back out to the buyer. So that's the market taker, someone that's actually using Curve to swap an asset. But as a liquidity provider, you're just simply putting funds in. It'll cost you Ethereum to put funds in, and it will cost you to eventually take your money out. But after that, you're not really being affected by the fees. However, the people using it are. And so that does affect the accessibility of Curve and other DeFi protocols. And what we're seeing is, well, much like Bitcoin, and the response that Bitcoin people would have is that, well, it's just not for people wanting to do $5 coffee transactions. And so in the same sense, a lot of the DeFi tools are going to be restricted to people that want to deposit tens of thousands of dollars worth of an asset, or want to loan $10,000 worth, or want to borrow over $10,000 worth of an asset. And at that scale, now we're looking at some reasonable fees. But admittedly, it is unfortunate. We do want to see a cryptocurrency world that is accessible globally. And with the fees as high as they are, that really isn't true. But at least we know that we're able to at least exercise the technology, exercise and look for any bugs, issues in the code and the smart contract. You can do that when fees are high, so long as someone can use it. And then hopefully the scaling technology makes what has hardened through this early use era now accessible to everyone else, where $100 loan can mean a lot to them. That's our hope long term. But we can still use it today. I've used it for my own personal purposes. I've literally taken out a loan on a DeFi platform and been able to pay off a credit card of a higher interest. So this worked for me. It was in the 5-figure loan, so the fees weren't so bad. And I think it's a real, actual, usable product. And it replaced me using an equivalent centralized service. So it was a perfect replacement. I'm super happy. I didn't have to provide any KYC, didn't have to say how much I was borrowing to any central entity. I just launched a wallet, connected to a website, and off went my funds. Out came back the money I wanted to borrow.
I think that is a real legitimate use case that people overlook. They look at DeFi, they think like, it's this crazy world. It's, all this gambling, whatever, degenerates, whatever's going on there. But you actually have companies in the crypto space. Edge is one of these companies. They pay all of their employees in cryptocurrency, have done for a really long time, for years and years, and I applaud you, Paul, for that, because you're like a trailblazer in that regard. And so there are people who need to make payroll. They need to do all of these things where they need to take out loans, but they don't necessarily want to miss out on the price exposure of different assets. So they don't want to sell their Bitcoin or their Ethereum or anything, but they will kind of lock certain money up so that they can take money out and then, pay it back when they have more liquidity. So there is a real use case for this stuff. And just before I pass it off to you, Paul, I do have another super chat. So Mitchell Valentino, who's also a member of NBTV. So thank you so much, Mitchell, for your support. It's really appreciated. I sent a chat, said, Naomi, this interview is top notch. I'm learning a lot. You've been on such a roll lately. Thank you. And obviously the credit in these interviews goes to Paul, because he's just such a wealth of knowledge in these things. So thank you, Mitchell, and thank you, Paul, as well. But Paul, actually getting that anecdote of you actually using these things, not just for trying to earn money, which is another use case, totally fine, but actually for like real world use of lending is very interesting.
Yep, exactly. And I think this is what will make it accessible. These services that, once again, have centralized alternatives, but are now accessible globally. For now, it's accessible globally for the people that can afford the fees, but then soon it'll be accessible globally to everyone. regardless of the fees, because we hope
Mm-hmm.
definitely, and we expect that the scaling will be solved. We've scaled every other technology that we've ever had to build, and I'm confident we can scale blockchain.
Mm-hmm. And also I will mention, so Mitchell, because you have access to all the NBTV interviews, you will be getting the Michael Igorov, founder of Curve interview very soon. That's all edited and just waiting to go out. So keep an eye out for that. And anyone else who wants to check that out, head over to nevybrockwell.com/memberships. Otherwise it will eventually be released as a podcast, audio only version as well. One final thing I wanted to touch on before we kind of get into our roundup, the decentralization of this, which I think is always on people's mind. They don't quite know whether, you know, someone at the end of the day has access to the contracts and can pull the money out, whether it's actually centralized, decentralized. Curve, before, you know, they did have this team in charge, and then they created a governance token, which kind of makes it more decentralized, right? The idea of introducing CRV is to kind of disperse that parameter, disperse that that responsibility. So how decentralized is Curve at the end of the day?
I have not looked at what parameters can actually be changed by owning the Curve token. If the entire contract and pretty much all of its functionality can be, and there's a good distribution of the Curve token, that's really it as well, is how many different people and different entities own certain amounts of Curve. So if that distribution is quite broad, then it can be a relatively decentralized product. You know, is the interface to Curve open source where people can download it, run it, and access the smart contracts? That helps in the decentralization as well. So without having looked at what parameters are kind of modifiable within the smart contract, I'm going to guess that it's quite decentralized in the sense that a lot of these developers really don't want to be in control of these products.
Right.
Because if they are, they're privy to a lot of really tight, restrictive, and fierce regulation. So just by incentive alone, it's very likely that they are unleashing a lot of their control. Now, that's on a technological level, they're unleashing a lot of the control. However, on the kind of distribution of the token level, that might be another story. So as we'd mentioned, you know, about 31% of the total supply is going to go to shareholders. Now, whether or not they sell them right away or have sold a lot of it right away is something that I can't know. It's really difficult to tell whether or not that's been liquidated. But 31% is a pretty high amount. I don't know the shareholder breakdown of Curve. Is it two big shareholders that own, you know, 15, 20% each, or are there 5, 10? I didn't research into their, you know, their investment rounds and whatnot. But you know, overall, the distribution that I'd mentioned of this 3 billion max seems to imply that they will have pretty good distribution and decentralization of ownership of the Curve tokens. There is an interesting thing we didn't talk about, though, with the Curve tokens as far as voting power. That voting power helps in the decentralization, is they are giving a time-weighted increase of voting power based on how long people stake their tokens. So the longer you decide to stake and lock your tokens, the more voting power you will have. Now, that might end up somewhat centralizing the ecosystem, because not many people will possibly want to stake for a very long period of time. It's hard to say what that has on the game theory, but it's one thing to be aware of. And it's an interesting game theory rule that they've applied that I haven't seen in other projects. Typically, you just own the token, you stake it, now you have a vote. But here it's the longer you stake it, the stronger of a vote you have on the governance of the platform. So
Right.
interesting
I thought that was
aware
cool.
of.
Yeah.
I thought those two as well.
Yeah, and also interesting to know that CRV isn't actually the governance token itself. It's the staking token that you put in to then earn the governance token, which is kind of a little bit of a difference. And someone was just mentioning in the chat that they looked at the contract to see if there is a place for admin keys, and it says set admin in the contract. So I'm wondering, you know, I haven't actually heard people be up in arms about Curve having access to funds or anything. I'm not sure whether these are like a multi-sig arrangement or what's going on there, or whether it's completely dispersed. Do you have any insight into that, Paul?
That I hadn't seen.
Yeah.
I know that there was the unofficial launch of the Curve token that had happened.
Yeah, let's talk about that, because that was pretty funny. Like, apparently this code, yeah, it's on GitHub. I asked Michael about that. So that's actually in the interview, like, where if people, do you want to explain the situation, and then I'll give you Michael's thoughts on all of this?
So I'll explain to the best of my knowledge.
Hmm.
Curve as a platform was launched in January of 2020, and that allowed people to do the buying and selling and liquidity providing of funds into the platform. But the Curve token wasn't launched until August. Now they of course always had plans to launch the token. They had been mentioning it, talking about it, and even put open source code for the token on GitHub. And so what happened was someone just simply launched the coin based on the code. An anonymous developer put it out in
Yeah.
the public. And the initial reaction was, whoa, this is a scam. Who's doing this? This isn't legitimate. Let's not actually support this token. But then after further review, looking at the contract that was deployed, it was determined by the Curve team that it was actually pretty legitimate. Like, he didn't change any of the code. It was exactly to spec with what was
Little
on GitHub.
bits, little bits. Yeah.
I hadn't
Yeah.
been aware of the little bits, but at least the little bits were small enough that they
Yeah. Yeah.
didn't really matter to the Curve team. So they decided to just effectively support that as their official coin. Now, the thing that does bring up interesting questions that is a little bit above my understanding is the fact that usually when you launch a contract, there's a specific key that launches the contract. And I imagine if it's another developer, then it's his key that launched the contract. Now, launching it doesn't mean you have control over it. But if there were any admin keys, there was a statement that said he had launched it with the right keys. That I didn't quite understand, because how would he have the keys of the Curve team to launch it with? And so there's a little bit of ambiguity there. I'm curious as to what you heard when talking with the team as far as the
Yeah.
key aspect of that launch.
Yeah, well, so that aspect of it. So Michael, I asked him about that, and he was like, yes, this happened. And we thought it was a scam at first. And it turns out like there were little parameters. And I asked which parameters had been changed. And he said, actually, there were parameters where the Curve team would have had certain controls over certain like distribution, like they'd be able to stop different things or whatnot.
Oh,
These were taken out. So the Curve team was given less
okay.
control as a result of this
Interesting.
more decentralized launch, which was interesting. And Michael's reaction was like, yeah,
Okay.
it makes
Yeah.
sense.
Yeah. Yeah.
And in
It would
terms of
actually
like
look
the
bad for them to unwind it.
right. And then in terms of like the keys, yeah, I mean, looking into that, it seems that the whoever it was, they like did the responsible thing and like
Yeah.
either handed over control or put in the actual keys, or something happened there. But I fuzzy on the details. But one little caveat that I would bring up is that because it was first launched, and everyone was like, no, this is a scam. Don't go near it, because they didn't know what was going on. It was just some rando on Twitter who was like, hey,
Right.
guys, yo, dog, let's get this show on the road. And I
Tokens
launched
go.
it. Let's go. And everyone's like, who is this guy? And then it started trading on exchanges. And then they're like, oh, God, people are trading this. They think this is real. Then they looked into it. It's basically the same thing anyway. And they're like, well, people are already buying this and they think it's legit. All right, let's go with it. The little caveat about that is that whoever deployed it first kind of had a little bit of a head start in
Yeah.
terms of being able to stake it. But if you actually look, I think they got like 20,000 tokens or something out of what, 3 billion. So it's really like, it's really not a huge deal. And so, I mean, when people have an issue with that, I don't share those concerns, but I do understand why people might worry about this. And I do understand that if you factor in that people were already trading this, it's basically the same why the Curve team decided to be like, okay, this is a decentralized project. Let's just go with it. It's not a huge deal.
Right.
So it seems like there are no admin keys for this. Otherwise, it wouldn't have worked that way. So it would have been able to be, it wouldn't be secure, and the Curve team wouldn't have trusted it. So
Exactly.
yeah, I mean, given all of that information, let's go into the final summary. Paul, talk to me about your feelings about this. We've talked about a lot of DeFi platforms.
Yeah, I
Is
know.
this something you're willing to buy $100 worth of?
I think I would actually, I'm going to first of all say yes. Right. My first answer is yes. I would be much more inclined to buy it once again if I would participate in its ecosystem, if I had the time to participate in the ecosystem, stake it, provide liquidity, because one of the benefits, which we didn't cover, of having Curve is that you can stake Curve and not just vote because you've staked, but actually boost the fees that you would receive from providing liquidity. And so that is a actual legitimate monetary value of the Curve token. And that gives you kind of that additional value for even having the token. Now, that's not something that I'm looking to do right now. It's not something that I can have the time to go play with the ecosystem. But I do think it's one that motivates other people to have the Curve token for. Like if other people are actually providing liquidity and they want that extra interest, then they will want to acquire Curve and therefore create an actual value proposition for the token. Hence why I'm saying, yes, I would buy it. Probably the second reason is it's just absolutely tanked in price right now, right? So when it first launched, it hit as high as like $50, crashed to about $5, and I saw all these articles saying, oh my God, it's like tanked to $5, and now it's like hovering around 40 cents. And that big hype in August of all the DeFi projects and all the airdrops and all of the liquidity mining, blah blah blah, it was really a huge bubble. And if you believe in the fundamentals of a project and what it can provide to an ecosystem, then you start to see past that. And much like we hear is you acquire stuff when there's blood on the streets. And from the viewpoint of the Curve token and similar other tokens in the DeFi space, right now there's blood in the streets. And so it's what I feel like is a relatively good time to buy for any project that I think has long-term value. And I think Curve definitely has long-term value. I found the need to use it myself. Our company has found the need to use it. And so I believe fundamentally in the project. And so, yes, I'll go in $100 of CRV.
I think that's a pretty great summary there. I think like relative to some other platforms, there seems to be less work required in order to make money. Like if you just kind of stake some money, provide liquidity, and then stake your CRV to get the boost, or I shouldn't call it boost because these are specific terms that refer to specific
Right.
things. So get the 2.5 times the amount, which is kind of interesting. Yeah, I would be interested in buying 100 as well and putting it in and seeing what happens. Yeah, I agree. DeFi space, I mean, it's fascinating to watch play out. I think this is a very interesting world that is laying the foundation for what the future is going to look like. We are entering this world of decentralized finance, and I love it. I love that people have access to liquidity and all these tools and lending platforms and all of that without the KYC and all of the bureaucracy and everything. I love that. I can't overstate that. I want to see that grow and continue to innovate. I want to see what people build on this stuff. We're early at the moment. We're in, these very young stages of this world. And so, yeah, there's mania. There's a lot of craziness going on. There's a lot of just degenerate gambling going on, as there is in the crypto space at large. But I'm very optimistic about what this is providing for people, the tools that this is providing for people, and the groundwork that this is laying for the future. I think it's awesome. I just got a super chat from Andre Amorim again, who says Edge. And that was the entire comment. So I guess that's for Edge. Is that for you, Paul? I will send
Great.
that.
Next time we see you can owe me a bottle of water.
Do you have a CoinTree account? I'll just send it.
Oh my God, I owed somebody else on the chat my CoinTree account, but I hadn't created it yet. So definitively before our next meeting, since we kind of had skipped a week, I will have a CoinTree account. But thank you anyway.
All right.
I think Naomi deserves every pound that you want to send for the show. So
I really appreciate that.
show for sure. So it's all hers.
I appreciate it, Andre. Thank you so much for your support. Thank you to everyone who's watching. That does conclude our show. I'm just going to refresh CoinTree. No CoinTrees today. You guys don't like crypto, clearly. But I really appreciate you guys being here and chatting, learning about this stuff. It's interesting. There's a whole world of all of these coins out there. A lot of people dismiss what's going on in the space. Even if we end up some weeks not purchasing a coin, not thinking it's worth $100, there's always something interesting going on in a project that we're covering. Something to do with like some innovation people are trying out, some new cutting edge technology. I love learning about this stuff and just seeing what's out there. And I'm so grateful for you guys that you love learning about it too. So thank you so much for joining us. Thank you to everyone who sent in a super chat. I really appreciate that. And we'll see you guys in the next episode. Paul, what are we talking about next time?
Oh my gosh, we're talking about forks.
We're talking about forks. So you guys may not be aware.
What is a year in crypto without a fork? There's almost a single year.
A contentious fork at that.
Yeah,
so the last contentious fork we had was like Hive Steam, I think, was a big contentious one. This one is contentious. This is a Bitcoin Cash fork, November 15. They have predetermined forks every 6 months on Bitcoin Cash. And that's just because they want to implement changes. They want people to know in advance that we always have these forks. I think it's a great idea. This one, though, two different sides have decided to be incompatible with each other, which is potentially going to create some irreconcilable fork, and we're going to dive into it. So November 15 is the fork. Our next episode will be in 2 weeks' time, and we're going to dive into what each of these different fork chains are about, how they differ from each other, so you guys can learn all about that. And we'll also be able to talk about the aftermath of this, because right now it's up in the air, not quite sure what's going on. It seems to be heavily weighted on the side of BCHN, but we'll have to see. So tune in then, guys, and thank you so much for joining. We'll chat to you soon.
Great weekend.